Hi and welcome back to the channel. Today we are going to be going over the discounted cash flow valuation model. First of all, we're going to understand the DCF valuation model, and then in the second part of this video we're going to be creating a DCF valuation model from scratch using a real example. We're going to be using Facebook and Tesla because obviously they're contrary to each other, where Facebook's producing consistent profit. Tesla is yet to be profitable but has a lot of potential ahead of it. So we're going to be looking at the different ways in which you can produce a DCF model depending on the company that you're doing. So what is a DCF model and why is it useful? So we are trying to calculate what Warren Buffett calls intrinsic value of a business, or more widely known as the fair value of a business. So Warren Buffett says the intrinsic value of a business is the discounted present value of all future cash flows between now and Judgment Day. So what does that actually mean? So in simple terms, a DCF model calculates the present value of the cash a business will produce in the future. 5 to 10 years is usually the period. It discounts the cash back to the present day using a discount rate or required rate of return. This is because of the time value of money, which essentially means $1 today is worth more than $1 next year, because you can earn interest on that money or invest it for a return. So there's an opportunity cost there. Technically, if your projections are 100% accurate, then this is a theory. If you buy at the intrinsic value, you can expect your return on investment to be exactly the same as the discount rate or required rate that you used. So the two types of DCF models. So you've got the academic version and the institutional, otherwise known as the intrinsic versus relative, which is what the academics call it. It's important to understand both approaches and why each side uses it. Generally, the academic approach tries to prevent having unnecessary assumptions by using a perpetual growth rate into infinity rather than an assumed exit value. They also use a WACC, or weighted average cost of capital, which is more of a generalized discount rate, as they're not aiming for an investment return. Rather, they're just calculating an asset's general intrinsic value, or inherent value might be a better word. Preventing flaws in their valuation is the primary goal. The institutional or investor approach carries the belief that stocks or businesses will likely always carry a sale value in the future as long as they are still operational. They're not afraid to make assumptions, but use collective sets of real data to make accurate assumptions into the future. An investor in many cases will use a required rate of return for the discount rate over the weighted average cost of capital, as the weighted average cost of capital would actually not be much use to them unless it's exactly the same as their discount rate. Both have their flaws but can be used to good effect. So as I say, it's important to know both of them and why both sides uses it. What's the benefits of both and what's the flaws of both? So the components of a DCF model and how to calculate intrinsic value. This is just an overview. As our present value derives from the sum of all future cash flows, we need to first predict the future cash flows that the business is likely to produce. The easiest way to do this is applying a growth rate to the current financials of a business, basically making assumptions. I like to use free cash flow as it represents the cash left over after accounting for cash outflows to support and maintain the business operations, and essentially is the money that's available to distribute to shareholders of the business if the business wishes to. Once we do the above, we can then estimate our terminal value, which in many DCFs will make up the majority of the present value. In the majority of DCF models, the terminal value represents an exit or sale value of the business at the end of the period. Essentially, we're estimating that we can sell our investment in the future and it will be for a multiple of, say, earnings or cash flows. Once we have the sum of future cash flows made up of annual free cash flow and the terminal value, we need to apply our discount rate. I would always advise using your personal minimum rate of return. 15% is mine, for example, rather than a weighted average cost of capital, which, as I said earlier, is more of an academia approach to fair value. Now, I've highlighted in bold here the key components. So the key components are growth rates, free cash flow, terminal value, and discount rate. Ways in which we can calculate free cash flow into the future. So the first one's estimate a free cash flow growth rate and apply it to the current free cash flow. As you can see, this is not advised. This is probably the easiest way to do it and will prove to be the least accurate. Second, forecast net income or EBIT and apply a historic average of the free cash flow to earnings ratio, i.e. free cash flow is usually 95% of, say, net income or EBIT. And then the third, which is forecast EBIT, and then less taxes, add back depreciation and amortization, less capex, less the change in net working capital. But sometimes you can simplify this by just taking EBIT, deducting tax and capex, and then you avoid the balance sheet corrections altogether. It may not be as accurate. You have to really have a look at the depreciation and amortization past numbers and changes in net working capital to know if they'll cancel each other out to do this. But which one you choose out of these three will really depend on the company. So you can't choose options 1 and 2 for a company that doesn't generate free cash flow yet. So by default, you have to go with the third option, which is obviously the more complicated and complex option, but will prove more accurate over time. On the contrary, it would make things more complicated than they are worth if you used option 3 on a company that always has very consistent free cash flow growth or free cash flow to EBIT percentage, as this will likely average out the same into the future. Personally, I like to use option 3 for a business that are not yet achieving consistent profit, as I said, because it will prove more accurate and you just generally can't use 1 and 2. But sometimes I settle for option 2 when there is a consistent trend with earnings and free cash flow. And as you see, I'm going to use it on our first example. So building the DCF model from the top line, I always like to make it a revenue-based financial model, meaning that all other metrics stem from the top line. This makes us think deeper about our valuation by understanding where business sales are going to come from, what products or units will drive growth, what are the potentials for profit from those areas of the business. Remember, different products and services carry different margins in many businesses. To do this, we have to look at historic performance, look at profitability metrics, understand the current life cycle of the business, and analyze its competitive advantage and its total addressable market. It's hard to do this by just looking at earnings, as you'll find yourself working either backwards or just applying growth rates without any real context. This usually leads to a flawed valuation, misjudgments, and all around just a less valuable DCF model. For example, if we were valuing Amazon and decided the majority of their growth is going to come from the cloud business in the future, we would be estimating higher EBIT margins than if we believe the majority of revenue will come from e-commerce, which is a lower gross margin business. So how can we know the profit that AWS will produce in the future and what that will look like, or how that's going to affect Amazon's total bottom line numbers without analysing AWS and that sector of the business separately? We just can't do it. Again, this will depend on the business we are analysing. A soft drinks company or hotel company that only sells one product and is at the latter stages of their life cycle will likely not change much into the future. Therefore, it would be wise to adjust our valuation accordingly. As although it would still prove slightly greater accuracy, it may not be all that worthwhile. So building a DCF model for Facebook and Tesla from scratch. Let's just jump in to the Excel model we're going to build for these companies. You can see how I go through the process. And if you stick around to the end of the video, I'll be showing you a downloadable valuation model template that you can use to find the intrinsic value of any company that's producing free cash flow currently. All the formulas and calculations are preset. You just have to put in last year's financials. Okay, so we are going to be starting with Facebook. I'm just going to copy over all of the historical financials from Yahoo Finance. If it's a widely followed company like Facebook, then I tend to be comfortable doing so. So I'm just copying over all of the financials that I need. As you can see here on the left, we've got revenue, EBIT, free cash flow, shares outstanding, cash, debt, and there's some balance sheet information, and then the market cap and share price, so we can look at how it was trading in the prior years. I sped this up because it takes a long time to do it, but obviously I wanted to show you the full process. Obviously, Facebook's a company that has really, really good financials, really strong financials. There's some stuff in here that, if we were doing a company, there's some stuff missing from here that if we were doing a company like we'll do in the next one with Tesla, a company that's not turning a profit yet, we would need to look at some extra metrics just so we can come up with free cash flow in a different way, because in this method, we're going to be using free cash flow over EBIT to calculate the free cash flow into the future. Obviously, we'd have to do a different method if we're doing a company like Tesla. So hopefully this will be done in a second, then we'll jump into the assumptions. All right, before we get into the assumptions, I just wanted to show you what I've done on the formulas. So I've put in growth formulas or previous growth rates and previous margins, as well as previous free cash flow over EBIT, to see what the averages were, going back historically, so we can make a judgment over here on the assumptions tab. All right, so as you can see along this line, I've got the averages over the 4-year period as to what they've achieved. To be honest, that's a bit of an anomaly. That's 60%. So I'm going to go with the average. X that is more. It looks like a pattern of 85%. I think it'd be fair to go with that. Forward, it looks like 35% will be the average going forward. They were obviously getting higher margins previous to that, but 35 looks like it's the more normal margin for Facebook. Still a very high margin. 28% is the average growth rate over that period, obviously slowing in 2020 due to COVID. But I think it's fair to say that they could probably hit 20s for the next at least 3 to 5 years. So the next thing I've added in is our previous trading multiple. So I'm going with enterprise value to EBIT because that's how we're going to calculate our terminal value. As you can see, over the 4-year period, the average in these, the average at the end of each year is 21.4 times. If you take out the point in time where they were trading really cheap because of the Cambridge Analytica scandal, we get to 24 times. So we're going to make some judgments and the assumptions based off of that. Obviously, like I said, if you're doing this as a full valuation on a company, I would advise doing some extra research, some extra background work, and figure out the growth story that goes with the company and decide what your assumptions are based off of that. This is purely for demonstrating purposes at the moment, so please don't judge me on these forecasts for Facebook because they're going to be quite vague. Like I say, purely for demonstration purposes. So we're going to go with 10% on 5 to 10 years, but 20% in the next 1 to 5 years. So that actually averages at about 15% over the period. What you'll see is once we start to fill in all of these assumptions here, and I put in some of the formulas, essentially this forecast period here all works off of the assumptions keys over on this side. Everything in blue just means that it's formulated, there's macros in there and it's not hard-coded. Anything in black is just hard-coded. Okay, so let's start. Revenue is going to be times 1 plus the growth rate over here, and I'm just going to lock that in. And then we'll just slide it across to years 1 to 5, and then for years 5 to 10, we're going to have to use the 5 to 10 growth rate. And there you go. We have the top line revenue done. That's saying it's going to get to 300 billion in 2030. As you can see, I've got the formulas in there just showing us what that growth rate is. EBIT. So again, EBIT's just going to be based off of the assumption that we're getting a 35% margin over there. So let's just put in the 35% margin, and that will calculate our EBIT. So it's going from 27 to 30 in 2021. Seems reasonable. Slide that across, and then we've got our 2030 EBIT of 102 billion as well, keeping a consistent average margin of 35% over the period. That's sort of the best we can estimate. Free cash flow as a percentage of EBIT. Now, it looks like we said, the average that they achieve is 85%, and it looks fairly consistent. So it's a good metric to use. So we're going to run with 85% here to put that into our assumptions tab, and that's going to give us our free cash flow in 2021 of 26 billion from 23. So again, doesn't look unreasonable. And we're just going to slide that across. Sorry, slide it one more. And there we will get our 2030 free cash flow of 87 billion. Next thing we need to do is shares outstanding. Again, this is key to the assumptions tab over here. We're going to keep that at a consistent level throughout the period, although they probably will buy back shares in the future. We'll keep it at 0 for now. Just slide that across. That's going to keep consistent. Cash and cash equivalents, again, keyed into the assumption tab. Let's go with 10%. Just a nice rounded figure. Seems reasonable to say as well, especially if they're going to be producing that much free cash flow. So, yeah, I mean, when you look at it, yearly free cash flow is about 2/3 of the total cash amount, which is similar to, less than that now. So it seems doable. Debt growth, let's go with 5%. They've taken on some debt, but they don't really need debt. They are a very self-sustaining business. and we just drag that across. And now we've got our whole forecast period is complete. We've got all the numbers that we need. And now what we need to do is we need to work out our terminal value. So as I said, we're going to be going with an enterprise value to EBIT multiple. So we're going to base it off of the EBIT of 100 billion there. And we're going to go with, what's the average down there? 21. Let's go with 20. Fairly round figure. They should be selling for 20 times. 20 times seems a fair multiple for Facebook. If it's ever selling for that in the future, I will likely buy it. And that gives us a $2 trillion enterprise value in 2030. As you can see, that's derived from EBIT and the TV multiple here. Now I'll turn your attention to the DCF. So this is obviously the final part of our valuation model. As you can see, I put the formulas in already. We've got our enterprise value. We're just going to appear that here. We've got a less the debt and plus the cash, which are these year 10 numbers, to get our market cap in 2030, which is showing as 2.1 trillion. Divide that by the shares outstanding. Obviously, it's shares outstanding saying flat. That's going to be a share price of 758. Obviously, if they buy back, say, a lot of shares, then that share, minus 1.5%, let's say, we get a higher share price, starts looking like a more attractive investment. But let's go with no change at the moment. Discount rate, obviously I said my discount rate is 15%, so I'm going to keep it as that for now. And then off of a 15% required rate of return, we're showing an intrinsic value of $684 billion for Facebook and a share price of 238, that is. Now the intrinsic value part, let's just run through that. So what it's doing is there's an Excel formula that you can use without having to do the discounting manually, which is just equals net present value, and you highlight all of the cash flows over the time period, and it's going to discount them all back at the required rate of return that you're choosing, which gives you your intrinsic or fair value. Now, what this is doing, so I can just tell you how it works manually. Obviously, it's a lot harder to do it manually. It takes a lot more time, especially when you've got 10 years worth. What it's doing is it's taking that free cash flow amount here or free cash flow amount here, and it's doing a formula which is times 1 minus the discount rate. So it's essentially, and then to the power of however many years forward it is. So it's discounting this one back 15% twice, compounded, discounting this one back 15% 3 times, and so on and so forth. What's actually interesting is that if we take year 1, where we're getting 26 billion of free cash flow, and we actually discount that back at the appropriate rate, and we'll do that, 1 minus the discount rate down here, and then to the power of 1 because it's 1 year into future, that's saying that this is worth 22 billion. That 26 billion in a year's time is worth 22 billion today. Now, this is where it shows you the power of backwards compounding, if you like, or reverse compounding. This number here in year 10, which is a much larger number, 87 billion, but because it's 10 years into the future, we need to discount it back at 15% 10 times. I didn't lock in the growth rate. V30, the growth rate. That 87 billion in year 10 is only worth 17 billion to us today. That first year free cash flow, although it's about a quarter of this amount, is worth more to us today than the 10th year free cash flow. Which means that the majority of the value is coming from the terminal value. But I thought I'd just demonstrate how the reverse compounding works. So yeah, I'd probably recommend just doing the net present value formula. It works, it's accurate, and it will give you the same number. So intrinsic value of 684 billion, share price of 238. A little bit off the stock price at the moment. I think it's about 270 at the moment. So we're a little bit off, but I wouldn't be surprised if you see it come back down to that in the future. It may or may not, but that's probably a fair price to buy Facebook. And as of the point of this video, if our forecasts are accurate, or they're even a little bit conservative, we can expect a 15% or better rate of return over 10 years, which is a fantastic return to get over a 10-year period. I've got down here a margin of safety, so if you're worried about your assumptions, and I'd probably say if you're using assumptions that are quite high growth rates or quite high multiples, so if you've got a bit of a bullish assumption, maybe use the margin of safety feature. Here I've got a 25% margin of safety, and all that's doing is obviously taking about 75% of the intrinsic value and saying we want to buy it at 25% discount to intrinsic value, so $179. Okay, so there you have it, a Facebook valuation model built entirely from scratch, and you can see the whole process of how I went about it. Really not that difficult to do once you get used to doing it, just a little bit time consuming. And obviously, if you were doing a real valuation and getting ready to invest in a company, like I say, you will need to do more research than just looking at the historical financials to come up with the future assumptions. But I hope you enjoyed it. If you did, please leave a like, comment, let me know what you thought, and subscribe for more videos. I'm going to be doing the Tesla one in a separate video just because this one is obviously quite long now. But in the Tesla one, we're going to be demonstrating how we do a DCF valuation model on a company that is yet to produce free cash flow or earnings. So make sure you look out for that. It's going to be different, slightly different to this one. And I just wanted to show you this. This is my template, or a DCF valuation model template that you can use to value any company that's currently producing free cash flow. As you can see, all the formulas are built in. All you need to do is start putting in some of the historical financials. That's the only work you need to do. And pick your growth assumptions, margin assumptions, etc. Multiple, TV multiple. And as you see, you've got a discount rate you can choose down here, and it will provide you the intrinsic value. So all of the calculations are done for you. All you need to do is put in the historical results. So I'll leave this available for people in the comments section to download, and you can start valuing whichever company you wish. So like I said, if you enjoyed it, please leave a like and subscribe to the channel. The Tesla valuation model will be coming out very shortly. But until next time, good luck with your investments.